Let me be blunt with you right now because nobody else in your life is going to say this to your face. Gold just broke through record highs. Central banks around the planet are buying it by the 1,000-ton load. And the average investor sitting there watching this with your savings parked in a checking account earning 2% interest, you still think gold is something your grandmother wore around her neck at church. That is not a personality quirk. That is a financial death sentence written in slow motion. And the tragedy is that you signed it yourself without even reading the document. I have spent decades studying markets, watching companies, reading balance sheets, and the single most important financial truths I ever learned was not about stocks. It was about money itself, what it is, what it isn't, and what happens to the person never bothers to find out the difference. You are about to find out, and it is going to be uncomfortable, and that discomfort is going to save you. If the last 60 seconds made you think even slightly differently about your money, hit subscribe right now, because what I'm going to give you in the next 25 minutes is the same framework that Wall Street's most senior portfolio managers use to evaluate gold, monetary policy, and macro risk. Investment banks charge institutions tens of thousands of dollars per year for this level of analysis. You are getting it completely free, and the only price of admission is that you pay attention. You do not tap out halfway through, and you actually do something with what you learn. Subscribe, do it now, then let's go to work. Here is the first thing you need to hammer into your brain. And I want you to really sit with this because it runs completely contrary to what your broker, your financial advisor, and every glossy magazine on the planet has been telling you. Gold is not an investment. I know that sounds like I just pulled the rug out from under the entire conversation, but stay with me, because this distinction is the most important financial concept you will ever hear. And getting it wrong has already cost millions of ordinary people their retirement security. An investment is something that generates cash flow. When you buy a rental property, tenants pay you rent every month. When you buy shares in a great business, and I spent my career finding great businesses, that company generates earnings, grows revenue, builds intrinsic value over time. A bond pays you interest. All of these instruments produce something. Gold produces nothing. It pays no dividend. It has no earnings per share. It does not open a new factory or hire more workers or develop a new product line. It just sits there. And that is precisely the point, because gold is not trying to be an investment. Gold is money. It is the oldest, most battle-tested, most universally agreed-upon store of value in the entire history of human civilization, and understanding that distinction changes everything about how you think about your financial life. Now, let me give you the science behind why humanity, across 5,000 years and every major civilization on Earth, independently arrived at the same conclusion. There are 118 elements on the periodic table. Every ancient civilization, without talking to each other, without the internet, without a global financial summit, chose the same one. They chose gold. That is not coincidence. That is engineering. Gold does not corrode. You can pull a gold coin from a shipwreck after 400 years on the ocean floor and it looks essentially unchanged. Try that with iron. Try that with copper. They disintegrate. Gold is divisible. You can melt it, cut it, shape it into coins or bars or thin flakes without changing its fundamental properties. It is malleable enough that a single ounce can be hammered into a sheet covering 100 square feet. And most critically, it is genuinely, physically scarce. You cannot create gold in a laboratory the way you can synthesize diamonds. You cannot print it. You have to dig it out of the ground at enormous cost and effort, and there is only so much of it. Here is a number that should stop you cold. All the gold ever mined in human history, every pharaoh's tomb, every central bank vault, every Olympic medal, every wedding ring, if you melted it all down into one cube, it would fit inside 3.5 Olympic swimming pools. 8 billion people, 3.5 pools. That is a supply constraint that no government can override. Now here is the example that clinches the argument and that I want you to remember for the rest of your investing life. A Roman centurion, a professional soldier of middling rank, earned approximately 1 ounce of gold per month, 2,000. Years ago, that ounce of gold would buy him a quality toga, a leather belt, and a pair of sandals, essentially a high-quality outfit, the equivalent of a well-tailored suit today. 1 ounce of gold right now is trading around $4,000 to $5,000. And what does that buy you today? A good suit from a quality tailor, a nice pair of shoes, a belt, and maybe a shirt to go with it. Gold did not go up. Gold did not perform. Gold just sat there being gold, doing what it has done for 5,000 years, telling you the honest, unfiltered truth about what your currency is actually worth. The dollar moved, the paper lost value, the gold stayed the same. That is your measuring stick. And once you see it that way, you cannot unsee it. Now I'm going to walk you through the single most consequential financial crime ever committed against the working and saving class in modern history. And I use the word crime deliberately, not for drama, but for precision. Because what happened on August 15, 1971, was the systematic dismantling of the one mechanism that protected ordinary savers from their own governments. To understand it, you need to go back to 1944 to a small town in New Hampshire called Bretton Woods, where 44 countries sat down in the aftermath of World War II and agreed on a global financial architecture. The United States held the majority of the world's gold because America had emerged as the primary beneficiary of the war economically. So the agreement was structured as follows. The US dollar would be pegged to gold at a fixed rate of $35 per ounce, and every other major currency in the world would be pegged to the US dollar. That meant the entire global financial system was anchored to a physical thing that could not be printed, could not be fabricated, and could not be inflated away by political pressure. It was the gold standard as the backbone of international finance, and for nearly 2 decades it produced exactly what sound money is supposed to produce: stability, growth, and the expansion of the American middle class. Then the 1960s happened, and the wheels came off. The Vietnam War was extraordinarily expensive. President Johnson's Great Society programs added enormous fiscal pressure. The U.S. government was spending dramatically more than it was taking in, which meant it needed more dollars in circulation, which under the gold standard meant it needed more gold, and there simply was not more gold. Other countries started watching the math very carefully. France, under Charles de Gaulle, called the bluff directly. The French government looked at the volume of dollars being printed against the declared gold reserves of the United States and concluded the numbers did not add up. France did not send a strongly worded letter. France sent an actual warship, a naval vessel, to New York to collect their gold bars from the Federal Reserve Vault. When Britain and other nations began lining up to do the same thing, what was happening was the oldest financial panic in the book, a bank run. Except the bank being run on was the United States of America. Richard Nixon went on national television on a Sunday night, interrupting a Western program, which tells you everything about the priorities of the moment, and announced that the United States was temporarily suspending the convertibility of the dollar into gold. 254 years later, that temporary suspension remains in place. In one speech, the anchor connecting the dollar to physical reality was cut forever. From that moment forward, the dollar was backed not by gold, not by silver, not by any hard asset, but by a government promise. This is what economists call fiat currency, from the Latin fiat, meaning let it be. The money has value because the government declares it has value. That is the entire foundation. And if that sounds thin to you, if that sounds like the kind of arrangement that could go very wrong under the right set of pressures, then congratulations, you are thinking more clearly about money than most people with advanced degrees in finance. I want to show you what that moment in 971 has actually cost you in cold mathematical terms, because this is not a philosophical debate about monetary theory. This is about the purchasing power of every dollar you have ever saved, every dollar in your retirement account, every dollar sitting in a savings account, earning a rate of interest that does not come close to keeping pace with what is being done to that money's value. In 1971, the broad money supply of the United States stood at approximately $860 billion. By 2021, that same measure had grown to $22 trillion. That is not a rounding error. That is a 30 times expansion of the money supply over 50 years, and the acceleration has not slowed. The Federal Reserve discontinued the broader measure of money supply reporting, which I note without a great deal of surprise. Because when a number becomes embarrassing enough, the institution producing it tends to find reasons to stop producing it. A dollar that existed in 1971 retains approximately 7 cents of purchasing power today. Not 70 cents, not 50 cents, 7 cents. The other 93 cents was not lost in a market crash. It was not lost in a bad investment. It was transferred out of your pocket through the quiet, relentless, mathematically inevitable process of monetary expansion. Think about what that means for a real person. Think about your parents or your grandparents who did everything correctly, who saved diligently through the 1970s and 1980s, who put money in the bank, who did not speculate, who lived below their means. Every dollar they saved with discipline and sacrifice is now worth 7 cents in real purchasing power. They did not make a mistake. The rules were changed on them without their consent and without adequate explanation. And then consider what happened in 2020 and 2021 during the COVID response, because this is where the scale of money creation becomes almost impossible to process rationally The United States government printed 40% of all the dollars currently in existence in just 18 months. The dollar has been the world's reserve currency for over a century, and in a year and a half, 40% of the entire supply was created from nothing. If a publicly traded company issued 40% new shares in 18 months, you would call it catastrophic dilution, and you would sell immediately. When a government does it to a currency, most people call it stimulus and vote for whoever signed the check. This is the mechanism of what I would call the quietest wealth transfer in modern history. When governments print money, the new money does not distribute equally. It flows first and fastest to those who are already holding assets, stocks, real estate, commodities, which rise in nominal price terms, making asset owners look wealthier while their purchasing power is in fact being maintained rather than grown. The people who bear the cost are the savers. The people holding cash, the people living on wages, the people who trusted the system enough to put their money in a bank and leave it there. Inflation is not prices going up. Inflation is your money going down. And the slow, invisible, year-over-year erosion of purchasing power is the most effective wealth redistribution mechanism ever devised. Precisely because it is slow enough and invisible enough that most people never connect the cause to the effect until it is too late to do anything about it. Now here's where the story gets interesting in a way that should genuinely alarm you. And I say that as someone who has always been skeptical of alarm for its own sake. For decades, literal decades, the official position of central bankers, treasury secretaries, and mainstream economists was that gold was, to use their actual language, a barbarous relic, outdated, primitive. A pet rock was no place in the modern financial system. These were the same institutions that were managing the fiat experiment. So you'll excuse me if I note the obvious. Conflict of interest in their opinion. But here's what those same institutions are actually doing right now. In 2024 and 2025, as you watch this video, central banks around the world purchased over 1,000 tons of gold in 2024 alone. That purchase figure has set records for 3 consecutive years running. Poland is buying, China is buying, India is buying. Brazil, Turkey, Kazakhstan, the list of sovereign buyers reads like a roll call of every nation that has decided it does not want its entire reserve position denominated in a currency controlled by a foreign government. And here is the specific mechanism that accelerated this shift, because understanding the trigger helps you understand the urgency. When Russia invaded Ukraine in 2022, the United States and its Western allies froze approximately $300 billion of Russian foreign reserves held in dollar-denominated assets. With one decision, $300 billion in savings was rendered inaccessible to its owner. Now, put yourself in the position of any other country's central bank governor watching that event unfold. You are sitting on reserves denominated heavily in US dollars, held in the financial system of a country that has now demonstrated it is willing and able to freeze those assets entirely if it disagrees with your government's behavior. The logical response is not complicated. You buy gold, you take physical delivery. You store it domestically, and you eliminate the counterparty risk entirely, because gold in a vault in Warsaw or Beijing cannot be frozen by a decision made in Washington. That is not speculation. That is rational institutional risk management responding to a real demonstrated threat. And then there is the debt factor, which I think is the most important long-term driver of this entire thesis. The United States currently carries close to $40 trillion in national debt, and that figure is growing at approximately $1 trillion every 100 days. Central bank governors can read a chart. They are not standing at press conferences announcing that they have lost confidence in the dollar because they are not institutionally positioned to say that publicly, but in their allocation decisions, in the actual purchase orders they are executing in the market, they are telling you exactly what they think they are buying, the one asset that has no counterparty risk, that cannot be printed, that cannot be sanctioned, and that has served as a store of value for 5,000 years. When JP Morgan is raising its gold price target to $5,000 and $6,000 and the People's Bank of China is executing the same trade simultaneously, the question you need to ask yourself is very simple. What do they know that you have not yet acted on? All right, now we get to the part where I stop diagnosing the problem and start giving you the framework for doing something intelligent about it. Because understanding the monetary system and then parking your money in a savings account anyway would be the most expensive intellectual exercise of your life. Let me walk you through the actual instruments and the specific risk profiles attached to each one, because not all gold exposure is the same, and buying the wrong instrument for your situation is its own category of mistake. Physical gold coins in bars is your foundation position. This is the asset that carries no counterparty risk. When you hold physical gold, you hold it. No institution can freeze it, no platform can suspend withdrawals, no bankruptcy filing affects it. The limitations are real. It generates no income. You need to insure it. And if the position becomes significant, you should be storing it in a professional, audited vault, rather than a home safe. But for the portion of your allocation that represents genuine financial insurance against systemic risk, physical possession is the only form of ownership that actually delivers what gold promises. The allocation frameworks used by sovereign wealth funds and large family offices typically sit in a 5 to 15% range of total portfolio value, not 0, not 90, not 55 to 15% as a hedge against the tail risks we have been discussing. Gold ETFs, instruments like GLD or IAU, give you price exposure without the storage and insurance burden. They are liquid, low cost, and they track the gold price efficiently. The trade-off is that you are trusting a financial institution to hold the underlying metal on your behalf. And if your reason for owning gold is a loss of confidence in financial institutions, you should think carefully about how much of your gold exposure you want intermediated through a financial institution. For most investors, a combination of physical gold for your core position and an ETF for your liquid, tradable allocation is a reasonable structure. Gold mining stocks are a different animal entirely, and you need to treat them that way. A mining company is not gold. It is a leveraged bet on the gold price filtered through all the operational, geological, jurisdictional, and management risks of running a business. When gold goes up 20%, a well-run miner might go up 40 or 60% because of operating leverage. When gold goes down 10%, the miner might go down 25%. If you understand that dynamic and you have the risk tolerance to ride that volatility, miners offer a return profile that physical gold cannot match. But do not buy a mining stock thinking you are buying gold. You are buying a business that mines gold, and that is a meaningfully different proposition. Finally, silver deserves a specific mention because the situation in the silver market right now is genuinely unusual. The COMEX inventories, the registered physical silver held in exchange, warehouses available for delivery, have been declining dramatically. Silver is not purely a monetary metal the way gold is. Approximately half of all silver demand is industrial. Electronics, solar panels, medical devices, electric vehicles. That industrial demand is growing as the energy transition accelerates while the mining supply is constrained and the above-ground stockpiles are being drawn down. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, sits currently around 60 to 65, which is roughly its historical average. The argument for silver is not that it is obviously cheap by ratio, but that the combination of monetary demand and accelerating industrial demand against a shrinking physical supply is a setup that the market has not yet fully priced. Physical silver premiums above the taper price are already elevated, which tells you the market is experiencing the early stages of a supply tightening that the headline price has not caught up to yet. I'm going to leave you with the most important concept in this entire conversation, and I want you to write it down because it is the framework through which you should evaluate everything that is happening in the global economy right now. My mentor told me something years ago that I have never forgotten. He said that great powers and great currencies do not collapse overnight. They decline the way newspapers did, slowly. Then suddenly, for years and decades, newspapers lost readers gradually. Every quarter the numbers were a little worse, and every quarter the industry said it was fine, it was manageable, it was a transition. And then one day, most of the newspapers in the world were simply gone. The decline was entirely predictable from the data that existed years in advance, and the people who acted on that data early were prepared. The people who waited for the headline moment, the obvious, undeniable front-page crisis, found there was no longer a front page to read it in. The dollar is not collapsing tomorrow. The fiat system is not ending next Tuesday. But the data, the debt trajectory, the money supply expansion, the central bank gold purchases, the de-dollarization of reserve portfolios globally is telling you exactly what the newspaper circulation numbers were telling the publishing industry 15 years before the collapse arrived. Gold at record highs is not irrational exuberance. Gold at record highs is a signal, and that signal has been telling you something about the state of trust in the global monetary system. You can ignore it. You can dismiss it as doomsaying, or you can do what every serious institutional investor on the planet is currently doing: understand it, allocate intelligently, and make sure that when the slow decline becomes suddenly obvious to everyone, you are one of the people who is already positioned, not one of the people reading about it afterward wondering what happened to their savings. The choice, as always, is entirely yours. Make it a smart one.